Chairman Schweikert, Ranking Member Pascrell, members of the subcommittee, thank you for the opportunity to testify today on the costs to the American people arising from increased federal debt service. I've been a finance professor for more than 20 years and had the privilege of serving as the Assistant Secretary for Economic Policy at the Department of Treasury from 2019 to 2021. In fiscal year 2018, outstanding public debt was just under $16 trillion. Cost of servicing that debt totaled $351 billion. By the end of fiscal 23, public debt had risen to more than $26 trillion. Debt service increased to $666 billion. So while the debt outstanding has risen 67%, the cost of servicing that debt has risen 90%, the result of the higher interest rates we're seeing recently. Even before COVID hit, our nation was on an unsustainable fiscal path. While the CARES Act was necessary to mitigate the economic harm from the pandemic, that spending was entirely debt financed. Spending has not returned to its pre-COVID levels. According to CBO, as was just said, government spending will continue to rise, consuming 23 to 25% of national output each of the next 10 years, compared to the last 50 years of just 21%. Revenue forecasts are at 18% of national output, which are above where revenues have been for the last 50 years at 17.4%. This permanent spending increase means debt as a percentage of GDP will rise unsustainably. Financial report of the U.S. government forecasts that if this current policy were extended over the next 75 years, it would result in a debt to GDP ratio of 566% compared to just 78% 5 years ago. Debt service costs are the result of both the amount of debt outstanding and the interest rate environment. One might think that minimizing interest costs is accomplished by simply issuing the maturity with the lowest yield. However, it depends upon the time horizon over which one is minimizing debt service costs. In 2020, interest rates on one-year bonds were less than 10 basis points, while coupon rates on the 10-year were at 0.625 and on the 30 were as low as 1.25%. If one were merely looking to minimize debt service costs in 2020, one might think Treasury should have only issued short-term debt. Instead, the Secretary increased the quantity of long-term debt in 2020 that was issued. While that marginally raised debt service costs, the American people today benefit from the fact that we issued, quote, higher cost debt, because today Treasury is still just paying 62 basis points on the 10 years that were issued at the time, rather than the 4 to 5% that they would be rolled over at today. Significant academic work on the term structure of interest rates of debt issuances of different maturities finds it to be upward sloping because, as was mentioned, investors bear greater risk on long-term bonds. One might therefore conclude that interest costs would be minimized by issuing just short-term debt. However, the bonds issued in 2020 demonstrate that there may be market conditions where Treasury will reduce long-term borrowing costs by issuing long-term bonds. As the chairman mentioned, recently long-term bond auctions have shown less demand than normal, particularly from international buyers. The central banks of both Japan and China have been reducing their ownership of U.S. Treasuries, likely reflecting that investors are growing more concerned about our nation's long-term fiscal stewardship. Whether we should pull back on issuing long-term Treasury bonds depends on whether government policy succeeds in reining in the recent 40-year high inflation. Reductions in budget deficits, deregulatory unleashing of the American economy would bring down inflation more effectively than the Federal Reserve merely raising interest rates. Issuing short-term debt that can be rolled over at lower bond yields would reduce long-term debt service costs. If instead we continue running unsustainable budget deficits and disincentivizing output, locking in today's interest rates might best mitigate the potential costs of having to roll over debt at even higher interest rates. I know that some have expressed concern that foreign holdings of U.S. Treasuries are problematic for Americans. I would differentiate Chinese holdings in technology firms who provide inputs into sensitive national security tools or the purchases of farmland near military facilities as different than holdings in U.S. government debt. I believe we should welcome lower Treasury borrowing costs arising from foreign countries wanting to invest in our nation's future, provided that those investments don't sacrifice defensive capabilities. I believe we net benefit from being the world's reserve currency. In addition to lowering borrowing costs, it facilitates implementation of our national security strategy to monitor arms dealing, drug trafficking, and other illicit activities. Further, it facilitates using sanctions as an economic tool to punish bad actors, enhancing potential military and diplomatic activities. The impact on the American people of higher debt service costs extends beyond future tax rates. Rising interest costs will likely crowd out funding for other government services. Additionally, mortgage rates paid by American homebuyers directly result from the long-term borrowing rates for the U.S. government. I believe the best way for us to improve access to home ownership for young people is to get interest rates back down, which means the fiscal and regulatory policy need to assist the Federal Reserve in bringing down inflation. I look forward to answering your questions.
Thank you, Doctor. As a chairman's prerogative and an idiosyncrasy, I will go last on my questions. Think of it as batting cleanup. Mr. Fitzpatrick.
Thank you, Chairman Schweiker, for holding this hearing. There is no question that the greatest economic and national security threat we face is our long-term debt and deficit. We can point fingers and argue all day long about whether it's a revenue or a spending issue, but one thing is clear. There's only one thing that will fix the problem, and that is a bipartisan, bicameral solution where everybody comes to the table. Our national debt has increased more than $6 trillion just in the past few years alone. The United States is currently, our debt stands at $33.8 trillion in debt. And as we know, the primary objectives of the Treasury's debt management strategy is to issue debt in a regular and predictable manner, to provide transparency in the decision-making process, and to seek continuous improvements to the auction process. So, Mr. Smethers, I'll start with you. Do you believe the Treasury's current debt management strategy is meeting these objectives?
The auction design is, I think, fairly efficient. It's a very large market. The secondary market is very liquid. If, from an economist perspective, if we're going to start all over again, I actually would have the U.S. Treasury mostly focus on long-term debt issuance, even if it means a higher interest rate that is paid. And the reason why we currently have the situation that we have is that we have debt markets who are making bets against what they think Treasury will issue in the future, Treasury making bets against the debt market, and that's not competition. That is just an incredible source of uncertainty. Instead, Treasury should focus on what it actually does. There's a big bias currently in the budget right now where it rewards Treasury for lowering the expected costs, freeing up money for other things. But it doesn't penalize for anything like rollover risk that comes associated with that shorter-term cost. I would remove that budget bias. I have an idea in my written remarks to do that. But the real value that Treasury brings is the thing that private markets cannot bring, and that is the long-term risk-free asset.
Thank you. Mr. Faulkender, as I understand it, the Treasury's debt servicing strategy not only impacts private investment, income growth, and things like mortgage rates, but also impacts the federal government's ability to spend on other policies and programs. Is this correct, number one? To put another way, how does the dramatic increase in debt servicing costs impact the federal government's ability to spend money on other policies and programs?
So yes, it's correct in that the Treasury rate serves as the base rate for most, if not all, global financial transactions. When we think about pricing out the interest rates we would see on whether it's mortgage securities, whether it's on car loans, but even international bond issuances, the Treasury rate serves as a base reference rate that's used. And so while I wouldn't argue we should push towards entirely long-term, I think it's beneficial that Treasury issues the whole spectrum of interest rates to provide those base rates for a variety of transactions. And I think that their work with the Treasury Borrowing Advisory Committee to get guidance on where there are clientele effects or gaps in the maturity structure is beneficial.